Let's turn to our next guest, who isn't worried and says the magnitude of upside in Micron today shows the AI trade is back on. Michael Sansoterra is CIO at Silvant Capital Management. Michael, it's good to see you. This will have some people shaking their heads, others breathing a huge sigh of relief. What do you see happening here?
Yeah, this is a great measure of actual demand. Again, this is important to remember. There's not a lot of those left for this year. But Micron's demand and really what they're seeing from a contractual obligation going forward tells you that the fundamentals of the AI trade is very much alive. Short term, it was getting a little nerve-wracking there for some folks who are traders. We're investors at Silvant Capital, but traders were nervous, and that makes sense. But the fundamental, like Christina said, 75% of an EPS guidance range, pulling the TAM forward a couple of years. You've got north of 40% CAGR for the next couple of years. That's unheard of in memory. That tells you demand is off the charts.
So pull this together for me. It's like if I were asking ChatGPT, I'd say, I want one sentence that brings together what's happening with Oracle, what's happening with Micron, and what you presume to happen with the rest of the AI trade, all at once.
Okay, that's a big sentence. I would say that with Micron, we are getting a solid read that demand for chipsets continues. With Oracle, we are being reminded that free cash flow is the most important way to fund CapEx. And as the rest of the space is looked at for the next year, next 2 years, I think you want to stay with the winners. You want to be in the large cap names that are executing, that are paying the 80–90% of the CapEx that they keep increasing with free cash flow and not debt.
Yeah, our guest yesterday even was kind of bullish on Oracle in the long run and said, look, they're the ones who have the proprietary enterprise data. And as the models move in that direction, they think ultimately that's going to pay off. That's up to investors whether they want to make that bet right now, but I like your summary. So if free cash flow is the most important thing, what's that setup look like going into next year? Are they an outlier, or do we have to worry about the rest of the mega caps starting to face those problems?
Yeah, the mega caps look fine. Literally 80–90% of CapEx is fully covered by cash flow from operations across the board. So that looks great. The question really is Oracle. We don't own Oracle in the Virtus Silvant Focused Growth Fund, but we can see that the market doesn't want to see the debt and the amount of debt that's being required, right? So I think there's a tale of two cities here. There's the folks that are paying it with free cash flow, and they get a multiple. And there's the folks that have to borrow. If you look around, even outside Oracle, but some of the smaller players that are growing very fast, but also have to go to the market for debt, it's a different valuation. It doesn't mean it can't work. It doesn't mean the demand's not there. It just means that the market right now doesn't want to pay for that incremental risk. There's enough risk in AI in general, I think.
So you guys are laying your bets with those who are, have plenty of cash to fund these expenditures and have no reason otherwise to worry about this trade stumbling in 2026.
Yes, exactly right. It's the hyperscalers. It's the same story we've been hearing for a while. I know it gets old, but it is the Googles / Alphabets. It is the Amazons and Microsofts. It is absolutely NVIDIA, which we have a lot. It makes perfect sense that those guys would continue to see massive demand. They've got the capital to pay for it, and the growth continues.